This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're now going to go through and look at specifically identifying whether or not there is or isn't a lease within a contract between two parties. In the previous video, we just made a really simple assumption, didn't we? That company A was the lessor, company B was the lessee. Was it company A, being the lessor, owned the asset? Company B, as the lessee, used that asset for rental payments over a lease period. So we just assume that there was a lease. However, you've got to be very careful and look at the particulars of the contract between company A and company B to identify if there is a lease. If there is a lease identified, then we will follow the rules of IFRS 16. If not, we would have to go through there and follow the alternative treatment under the relevant accounting standard. So how do we go through there and identify a lease? And what I really like about this is that we really begin to convey the feeling and the flavour of what these IFRSs are all about and the new language that they contain. Okay, so what you've got there, if there is a lease, first of all, there needs to be a contract. So a contract between the two parties, is it A and B? Okay, but it's what that contract gives right to. Okay, so what you've got there is you see the word control the use of an asset. Okay, so going back there to control, if you control that asset, it meets the definition of an asset and therefore there is a lease. As company B, you are the lessee and therefore you recognize that lease within your financial statements. Okay, ignoring the low value and short lease exemptions that we have. Okay, and that comes straight from, is it paragraph 9 of IFRS 16. So there needs to be a contract and we need to control the use of an identified asset. Okay, again, think you need to pay particular attention to that word identified. Okay, think of it as a specific asset. Okay, not just any asset out of a group of assets. It's a specific identified asset. Okay, and then what the standard then goes on to do is add just a little bit more detail, because it starts talking there about what we then mean by control. And again, this is what I really like about the standard, in the way that it brings in the word control, doesn't it, by talking about whether or not we have the right to direct the assets or direct the identified assets use. So can we specifically dictate how that asset is used, when that asset is used, what that asset is used for? Okay, going back, think about groups. We spoke about control and we spoke about control as being the power to direct the activity. So if you can direct something, you have control. Okay, so here you direct the identified asset use, you have control. If you have control, you're going to have a lease. Okay, if there is a lease, you account for it under IFRS 16. Just note, again, come back to the definition of an asset: a resource that is controlled by an entity as a result of a past event, but more importantly, gives you an inflow of economic benefit. And here it says there, do we get substantially all of the economic benefits? Okay, which you should do if you're able to direct it. Okay, if you're directing it, you should get the majority, the substantial use of the asset, and therefore the substantial economic benefit. Okay, however, just note that there's just a little caveat, if you like, that's thrown in. Just note, if the supplier, now this is the way that the standard tends to talk about things initially, in that the supplier is company A, so if there's a lease, that is therefore the lessor. It can't say, however, if the lessor, because we're trying to identify if there is a lease. So we can't talk about lessee, lessor until we've identified the lease. So think of the lessor, in inverted commas, as the supplier. Okay, so if the supplier, the person who owns the asset, has a substantive right to substitute the asset, then that means that you do not have the right of use and therefore there is no lease. Okay, so what you've got there, if we just summarize it, then what you've got is, let's just say that if there is substitution rights by the supplier, okay, so they can take the asset that you're using and swap it for another one, then if that's the case, there is no lease. Okay, however, if there are no substitution rights by the supplier, then that means that there is a lease. If that's the case, then we're going to use, is it IFRS 16, and therefore that supplier will then become the lessor, and the person who's making the payment is the lessee. Okay, now that's the rules. Okay, so you need to think about control. Control means therefore an identified asset and being able to direct the use of it. That should then give you substantially all the economic benefits, and then just you need to think about these substitution rights. If the supplier can substitute the asset for a similar asset from the rest of the fleet, then there is no lease. However, if the supplier cannot substitute the asset and you have, if you like, sole use of that asset, then it is a lease. Okay, and this is where we need to think about examinability. What you need to do is watch this example. We'll go through and play around with this example, but you also need to locate the illustrative examples from IFRS 16. There's about 6 illustrative examples that cover similar areas whereby there is a lease and then there isn't a lease. Okay, and they look very similar, but there are subtle differences. And if you can cover those 6 areas, I think you're going to cover yourself for all aspects of examinability. Because as IFRS 16 gets introduced to the syllabus from September 2017, there is going to be a question somewhere on leases. Okay, there's going to be an industry-specific question on leases. I can guarantee, I don't know whether it's going to be in September, I don't know whether it's going to be in December, I don't know whether it's going to be in March or June, but there will be, won't there? Okay, it's a new standard. Okay, the examiner's mightily happy that there is another new standard alongside IFRS 15. Hurrah! Okay, and therefore there's lots to examine. Okay, if you go back and look at IFRS 15, it's been examined a lot, and yet it's only been in the syllabus, I think, for a year as I speak. Okay, so make sure you go through and find those illustrative examples, and make sure as well that you go through and work them and understand the answer. Don't just read the answer, make sure that you can put the answer in your own specific words. Okay, so let's have a look at it, shall we? Okay, the example is all about their identifying a lease, so there will either be a lease or there won't be a lease. Remember, there will be a lease if we control the asset. Okay, so if we have the direct use of it, and if we have is it substantially all the economic benefits, and then we need to think about the substitution rights. If the supplier can substitute the asset that we are using for another similar asset, then there is no lease. However, if they cannot substitute the asset, then there is a lease, and therefore the supplier becomes the lessor and we are the lessee, and IFRS 16 applies. Got it? Yes, brilliant. Let's have a look. Okay, what I'd like you to do, okay, is read this example. Okay, read through the example, go through the notes, have a look, and then play the video. Okay, so you're gonna have to stop it in a second, and then once you've stopped it, work the example. Once you're happy with it, don't look at the answer at the back, look at that afterwards. Okay, don't cheat. Cheats get nowhere. Okay, cheats never prosper. So work the example, Then when it's worked, you can come back and listen to me talk about it and then look at the answer as well. Are you ready? Stop the video. Did you stop the video? I seriously hope you did. If you didn't, you're wasting your time, okay? Don't just sit there and listen to me. I couldn't think of anything worse to do than listen to me continually, day in, day out. Try and be active within your learning, okay? Take responsibility for it. Therefore, work the example. So if you haven't worked the example, stop the video and then come back, okay? In the meantime, for those of you who have looked at it, worked it through, thought about whether or not we have control, whether that then means that we're able to direct the use of the asset, whether that means that we get substantially all of the economic benefits, whether that then means that we need to then look at substitution rights, depends upon whether it's a lease or a lease. How many times have I said that? Enough, let's get on with the example. I apologise, I'm waffling on purely because of the excitement of a new standard. Okay, so what have we got? It says there, explain each of the two following scenarios, explain for each of the two following scenarios if the contract is a lease or if it contains a lease. Okay, so is there a lease? Yes or no? Okay, so number one, question, was there a lease? Yes or no? Hands up, yes. Okay, good few of you. Hands up, no. Hands up, unsure. Okay, the answer here is yes. Okay, that there is a lease in scenario number one. Okay, why? Okay, because you look at both of them, one or two, they're the same, they're virtually identical in terms of the scenario. There's a subtle difference in them. Okay, let's have a look at them. It says here, Peach needs to transport its goods to customers in Europe using rail freight. Okay, so rail trains, doesn't it? Okay, the company enters into a contract, so there's a contract, so there could potentially be a lease within that contract with a rail freight carrier. So the rail freight carrier supplies the wagons for the train to pull. Okay, they are the supplier, we are the customer, and here it's for the use of 10 rail cars of a particular type. Is it there for 5 years? Okay, why does that mean that there's a lease? Okay, well, remember, there is a lease if we can control the use of that asset. So for 5 years we're going to use those 10 rail cars to deliver whatever freight it is that we decide. For freight, think goods. Okay, so whatever goods we want, we can put in those 10 rail cars. Those 10 rail cars only, no other rail cars. Okay, so therefore we're going to get the benefit from using those rail cars. We can direct the use of those rail cars in terms of what goes in them, in terms of how they are used. Okay, and there is no mention of any substitution rights, are there? Okay, the rail freight carrier cannot substitute another rail car in for one of those 10 rail cars. They can't say, well, we need this rail car, we're going to take it off you and give you something different to use. So therefore there are no substitution rights, so therefore there is a lease. Okay, happy with that there? Okay, excellent. Number two, you probably guess, can't you, by a process of elimination, but let's play the game. Is there a lease? Yes or no? Hands up of those of you who think there is a lease. Hardly anybody. Hands up those of you who think there is no lease. Virtually everyone. Okay, correct. And hands up those of you who are not sure. Shocking. How can you be not sure in the exam? What are you going to do? Sit there, go, oh, I'm not sure, I don't know what to do. You've got to have some conviction. Go with your first conviction, yes or no. Okay, if it's wrong, doesn't matter. Okay, so what have we got in number two? The answer to number two is that there is no lease. Okay, and if you read them, they are very similar. Peach needs to transport its goods to customers in Europe using rail freight. It's exactly the same sentence as the first scenario. The company enters into a contract with a rail freight carrier. Exactly the same as what we saw in the first aspect. However, what it then says is that the contract just requires the carrier to transport a specific or a specified quantity of goods using a specified type of rail car. Okay, so it could be any car. Okay, the supplier decides to go through and use to transport our goods. Okay, in accordance with the stated timetable, is it there for 5 years? Okay, so we can only use it based upon what's timetabled for the trains. Okay, previously there was no mention of the timetable, was there? Okay, so we could use it however, whenever we wanted. Here, we can't direct the use of the rail cars. Okay, the rail cars run on a timetable. Okay, those rail cars are a specific rail car, but it can be any of the specific rail car from the fleet. So we don't control a specified asset, do we? Okay, we don't have the ability to direct its use. We don't get the benefits from all of the rail cars, do we? Only get a benefit from the ones that we actually use. Okay, the supplier has a huge fleet of rail cars. Okay, and therefore there are substitution rights because they can swap one rail car for another whenever they see fit. You know, they put one rail car in the timetable 1 week and then another one the week after. Okay, so in this instance there are there are substitution rights. We don't have control. We don't have the ability to direct the use. We do not have substantially all of the economic benefits, so therefore there is no lease. Okay, and therefore IFRS 16 would not apply. Okay, again, I do think that could arise, maybe 4 or 5 marks to go through that and explain if it contains a lease. The detailed answer is in the class notes at the back. Okay, you need to maybe expand upon it just a little bit more based upon the specifics in the questions that you're given. But as I said, the key, I think, is to work the illustrative examples that you can find within IFRS 16. So just do a search, an internet search, illustrative examples, IFRS 16, and you will find the examples that we are talking about. You'll find that they are very similar in nature, but like here, each one has a subtle difference that means in one there's a lease and in the other there is not a lease. Okay, excellent. I'll see you all in the next lecture.